When an analyst examines a private corporation's financial statements, the optimization goal is highly specific, accurately measuring profit and the return on equity for investors. But when we shift our focus from the boardroom to the public square, that entire measurement system breaks down. Public sector entities do not exist to make a profit. Their primary objective is to deliver services to the public, whether that means maintaining roads, funding public schools, or managing national defense. Removing the profit motive severs the traditional financial feedback loop. In the private sector, investors use revenue and profit margins to directly assess performance. Without a bottom line to evaluate, citizens and taxpayers cannot use standard corporate metrics to determine if a government is succeeding or failing. This split-screen diagram illustrates the structural divide. On the left, the corporate cycle is a closed loop designed to return capital. On the right, the public sector cycle operates differently. Taxpayers provide revenue, driving budgets that fund service delivery. The ultimate output is accountability. To solve for this missing feedback loop, the International Public Sector Accounting Standards Board developed a specific architecture, the Conceptual Framework, and the General Purpose Financial Report, or GPFR. Applying corporate accounting metrics to sovereign entities misrepresents their actual financial health. To measure a government accurately, the reporting structure must shift from quantifying profitability to quantifying public accountability. To build this new reporting structure, we first have to identify who actually relies on it. The primary users of the GPFR are service recipients, the resource providers who pay taxes or donate, and the legislative bodies acting as their representatives. Unlike a majority shareholder or a corporate regulator, these users operate under a severe constraint. They do not possess the legal authority to demand custom internal financial reports from the government. They must rely entirely on the GPFR to assess the state's financial management. This reliance becomes critical when we look at how the public sector funds itself. This network maps the primary mechanism, involuntary taxation. Resources flow inward from taxpayers to the central public entity, and services flow outward to citizens. Look closely at the timing and volume of these flows. The resources extracted from a single node rarely equal the services provided directly back to that individual. The conceptual framework defines this structural asymmetry as a non-exchange transaction. An entity receives value from another party without giving equal value directly in exchange. The sheer volume of non-exchange transactions makes it mathematically impossible to determine an entity's efficiency simply by matching its revenues to its expenses. The cash coming in has no direct correlation to the specific services going out. Because service value cannot be derived from a simple revenue-to-expense ratio, the GPFR boundary must expand. It must capture alternative indicators of performance to show users exactly what their involuntary resources achieved. This brings us to the first necessary expansion of the reporting boundary. At the core, we have standard financial statements tracking position, performance, and cash flows. But to hold a government accountable, we wrap the core in a new layer, budget compliance. A public entity operates within strict financial constraints established by law. Adherence to this legally approved budget is the primary mechanism for financial oversight. It is the document justifying the involuntary raising of resources from taxpayers in the first place. Confirming that a budget was followed provides legal assurance, but it says nothing about the quality of the result. To address this, we add a second expansion. We add a layer for service delivery achievements. The GPFR must report non-financial outcomes alongside the raw financial costs. This means detailing the volume, the quality, and the frequency of the services provided. By tracking these non-financial metrics, users can assess the economy, efficiency, and actual effectiveness of the government's daily operations. Evaluating a government's surplus or deficit is meaningless in a vacuum. The numbers only gain value when you know if the legal budget was followed and if promised public services were actually delivered. There is a final variable that distorts standard accounting in the public sector: time. The concept of sovereign longevity dictates that nation-states and municipal governments operate on multi-decade horizons. They outlast standard economic cycles. Current year financial statements look backward. They fail to capture the long-term unfolding liabilities of massive social programs or multi-generational infrastructure commitments that governments take on. The policy and spending decisions made by a government today will directly dictate the tax burden placed on future generations of involuntary resource providers. To capture this time horizon, the GPFR requires a final structural expansion. We encapsulate the entire model within prospective financial and non-financial information. This data is essential for assessing the long-term sustainability of current service levels against shifting demographics and economic vulnerabilities. The GPFR must provide the data necessary to predict if the public entity will need to raise additional resources in the future just to maintain its current trajectory. A true picture of public financial health requires projecting current commitments decades into the future to protect the solvency of the next generation. With the outer boundaries established, we have to look back at the core financial statements to examine how the public sector objective alters the physical assets themselves. This split composition highlights the difference. A corporate factory is held specifically for its ability to generate future cash flows. However, public sector assets, like military infrastructure or national parks, are held primarily for their service potential. They exist to provide defense capability or public use. This severely complicates standard valuation. There is no competitive, liquid market for specialized historical artifacts or interstate highway systems, which limits the use of traditional measurement bases. Sovereign power also extends beyond traditional ownership. Governments exercise regulatory control over natural resources, like mineral reserves, water rights, and the electromagnetic spectrum. Because these public assets exist to maintain societal well-being and security rather than to generate revenue, traditional asset measurement principles require strict reinterpretation within the public sector framework. Mandating multi-decade perspective data introduces immense subjectivity into financial reporting. To keep the GPFR rigorous, the framework enforces specific qualitative characteristics. A direct tension exists between verifiability and subjective estimates, like projecting the effectiveness of a social welfare program 20 years from now. To resolve this, the framework demands faithful representation. Even when dealing with highly uncertain perspective information, the data depiction must be complete, neutral, and free from material error. The assumptions driving the estimates must be totally transparent. This brings us to the mandatory role of prudence. Preparers must exercise extreme caution when making judgments under conditions of uncertainty. You do not overstate assets, and you do not understate liabilities. These qualitative characteristics act as a vital constraint. They ensure that the expanded scope of the GPFR remains a precise analytical tool, rather than drifting into a speculative policy document. The IPSASB conceptual framework yields this complete architecture. It links the core financial statements to legal budget compliance, current service delivery, and long-term prospective liabilities. This expanded reporting model bridges the gap between raw, backward-looking financial data and the reality of ongoing, complex public sector obligations. Ultimately, this framework serves the users who fund the government involuntarily. It provides the transparency necessary to evaluate the state's enduring commitments over time. The conceptual framework operates as a structural mechanism to quantify the social contract. It forces a public entity to precisely account for the resources it extracts today and the services it promises to deliver tomorrow.